Assalamualaikum and hi everyone. We are from Group 5 and in this video, my group and I will discuss about two news, namely Asian currencies hit new 2023 lows as economic growth struggle from Nikkei Asia and an undervalued yen poses problems for the Bank of Japan from East Asia Forum. The first news will be explaining about the factors impacting the currency's performance, while the second news will be explaining about the challenges posed by an undervalued yen for the Bank of Japan and also the implications and issues associated with the yen's valuation.
The recent struggles in Asian currencies such as the Japanese yen, South Korean won and Thai baht can be attributed to a combination of factors primarily driven by the evolving dynamics of global interest rates. The US Central Bank's commitment to a hawkish monetary policy signaling potential further rate hikes has played a significant role in this scenario. The Japanese yen, South Korean won and Thai baht have all faced downward pressure against the US dollar, reaching their lowest level in the current year. This depreciation is a consequence of the widening interest rate differentials between the US and Asian economies. While many Asian central banks, including those of Japan, raised interest rate in the past year, they have largely maintained a steady stance in 2023. This decision, possibly driven by the hope that earlier rate hikes would curb inflation, has left their currency vulnerable in the face of US Federal Reserve's continued hawkish rhetoric. Also, the Japanese yen has been particularly affected, remaining above 149 yen per dollar near an 11-month low. Dovish comment from Bank Asian Currencies Japan Governor Kazuo Yuda, emphasizing the commitment to ultra-easy monetary policy, have further added to the pressure, despite warning from Japanese Finance Ministry Shunichi Suzuki about undesirable currency fluctuations. Market players anticipate a potential intervention by the Bank of Japan if the yen continues to depreciate. The broader economic uncertainty is evident in the cautious approach of Asian central banks, reflecting concern about the global economic outlook. Some economists even anticipate policy easing in the region to support struggling economies. The Asian Development Bank recently lowered its 2023 growth forecast for the developing Asia, citing high interest rate and China's property crisis as growing risks. There are expectations of rate cuts by central bank in the region. Nomura economists predict the Bank of Korea to start cutting rate in January, and capital economists hold a downbeat view for emerging Asia, expecting rate cuts by Bank Indonesia by the end of the year, and the Philippines and Thailand in the first quarter of 2024. These policy adjustments are seen as responses to weak GDP growth across emerging Asia, influenced by tight monetary policy and subdued activity both at home and abroad.
Next, we will move to the factors impacting the currency's performance that are discussed in the article. Like a powerful wave crashing against the shore, the value of ASEAN currencies has taken a big hit in recent times. It's like they are swimming against a strong current, and there are a few reasons behind this struggle. First of all, interest rates are on the rise, both at home and abroad. This makes it more appealing to invest in things that use US dollar, which push down the value of ASEAN currencies. It's like a game of tug of war, and the dollar is winning right now. Secondly, economic growth in Asia is facing some challenges. Things like the struggles in China's property market and worries about El Nino have slowed things down. This makes investors less confident about ASEAN currencies, so they are selling them and looking for safer bets like US dollar. Third, the difference between interest rates in Asia and the US is getting bigger. This makes the dollar even more attractive, like a magnet pulling in investors. However, it's not all doom and gloom. The impact of these challenges varies across different ASEAN countries. Some are handling it better than the others, especially those with strong local markets and less reliance on exports. So, what's the takeaway? ASEAN currencies are facing tough times, but it's not a lost cause. With smart economic choices, spreading their bets and focusing on their strengths, ASEAN countries can ride out the storm and come out stronger on the other side. Just like a surfer catching the perfect wave, they can turn this challenge into an opportunity to shine.
Bank of Japan is facing a difficult dilemma. The Japanese yen has fallen to its lowest level in decades, and while this might sound like beneficial for exports, it's actually creating a host of problems for the central bank. Japan's exchange rate environment made a big turnaround in 2022 when the yen began to depreciate sharply, and it exceeded 145 yen against the US dollar by September 2022, and then 150 yen in October. The Ministry of Finance conducted 2 rounds of foreign exchange interventions, partly due to the decline in long-term interest rates in the United States from November 2022. The exchange rate returned to below 140 yen. The response from the Bank of Japan also contributed to the appreciation, leading to the yen reaching 130 against the US dollar by early 2023. But the yen is still considered undervalued compared to the Japan economic fundamentals, which are around 100 to 110 yen. The extreme depreciation of the yen resumed from May 2023. Since early 2022, the yen has declined by an average of 20% against major currencies. Against the US dollar, the yen depreciated by around 30%. One of the biggest challenges is inflation. The Bank of Japan has an inflation target of 2%, but the weak yen is making it harder to achieve that goal. Why? Because imported goods become cheaper, putting downward pressure on domestic prices. The Bank of Japan could try to stimulate inflation by cutting interest rates or expanding its quantitative easing program, but these options are already stretched thin, and there's a risk of unintended consequences like financial bubbles. Another challenge is economic growth. While a weak yen can boost exports, its effect is being blunted by rising input costs and supply chain disruptions. On the other hand, higher import prices are eating into consumer spending, which is a major driver of economic growth.
The news outlines a series of implications and issues associated with the yen's valuation, emphasizing its significant depreciation and the challenges it poses for Japan's economic landscape. The yen's sharp depreciation exceeding 30% against the US dollar is primarily attributed to the Bank of Japan monetary easing policy, known as yield curve control. The Bank of Japan has maintained short-term interest rates at negative 0.1%, and a 10-year interest rate fluctuation range has been permitted. Unlike the US and Europe, which are shifting towards interest rate hikes to combat inflation, the Bank of Japan commitment to yield curve control has widened the interest rate differential, leading to the significant depreciation of yen. This depreciation has far-reaching consequences. Import prices are soaring due to the weakened yen, resulting in Japan's inflation exceeding the 2% target. The Bank of Japan revised the inflation rate for the fiscal year 2023 from 1.8% to 2.5%, with current inflation in the 3% range. This inflation, driven by factors such as rising food prices, erodes the purchasing power of consumers, contributing to a decline in real consumption. Despite the yen's depreciation, Japan's trade deficit persists, and export quantities have not increased. Industrial production and corporate investment remain sluggish, indicating that the depreciation hasn't led to the expected boost in economic activity. The challenges are further compounded by the imbalance between inflation-induced tax increases and lagging wage growth, while the services sector benefits from increased foreign demand due to the yen's depreciation. The overall economic picture reveals a complex set of issues that require careful policy considerations.